The biggest players on Wall Street are quietly loading NIO, while the most retail investors have completely written off. While the headlines scream doom and gloom, the smart money is making calculated moves. Welcome back to Smart Stock Sam, where we cut through the noise and follow the money. I'm Sam, and today we're diving deep into NIO and what's happening behind the scenes with institutional money, and the CEO's bold new strategy is something you need to see before April 10th. We're talking about major players buying big, a strategic transformation flying under the radar, and a catalyst event that could reshape this entire thesis. By the end of this video, you'll understand exactly why institutions are positioning aggressively and why the market might be missing a 60% upside opportunity. So buckle up, because this is going to challenge everything you thought you knew about NIO. For the first time in NIO's entire history, the narrative has fundamentally flipped. And I mean fundamentally. For years, this was the story of burning cash faster than they could raise it, burning through investor confidence with every quarterly report, and barely surviving quarter after quarter while critics questioned whether they'd even make it to 2026. The skeptics were loud, the short sellers were aggressive, and frankly, the data supported their concerns. But here we are in February 2026, and something remarkable has happened. We're not looking at a struggling startup anymore. We're looking at a strategic blueprint for global stability, the company that everyone counted out, that analysts said would never reach profitability, has just posted something Wall Street didn't think was possible this soon. And the market? The market is still pricing them like it's 2023. Yet if you pull up NIO's chart right now, you'll see it trading around $4.98. The broader market consensus? A lukewarm hold rating. But here's where it gets interesting. The fundamentals are screaming something completely different. We're talking about a potential 60% upside with a bull case target of $8. So why is there such a massive disconnect between what the stock is priced at and what it's actually worth? The answer lies in a structural pivot that's about to be triggered by a high-conviction event this spring, and most investors are still looking at yesterday's data. To understand where we're headed, we need to pinpoint the exact moment everything changed. Fourth quarter 2025. This is the inflection point. NIO posted their first ever quarterly operating profit, landing between $101 million and $173 million. Think about what that means. With a market cap over $10 billion, NIO isn't being valued on hopes and dreams anymore. It's now being traded on fundamental earnings potential. The math has changed, and the market hasn't caught up yet. But here's the thing about reaching the peak. Staying there is an entirely different challenge. CEO William Li has been incredibly vocal about something he calls new car death valley. This is the danger zone where sales momentum stalls after the initial launch hype fades. It's that brutal gap between early adopters and sustainable mass market scale. And if a car company can't bridge this gap, they collapse. So the big question is, can NIO survive what's killed so many others? Here's where the story gets fascinating. While everyone obsesses over vehicle delivery numbers, the real story is hiding in plain sight. NIO's non-automotive business, their services and energy sector, was already profitable in the first 9 months of 2025. Let that sink in. By decoupling these energy margins from the volatility of car sales, NIO has effectively de-risked their entire path to full-year 2026 profitability. They're not just a car company anymore. They've built a parallel revenue engine that most analysts are completely overlooking. But how do you turn massive battery infrastructure into a profit machine? It all comes down to clever financial engineering. Batteries typically eat up 30 to 40% of a vehicle's cost. That's a massive weight on any balance sheet. But NIO pioneered something brilliant, the Battery REIT model. By issuing $72.5 million in battery REITs, they've moved those heavy assets into an investor-funded pool. They've completed over 100 million swaps across nearly 3,800 stations globally. Battery as a service isn't just a buzzword. It's become a liquid financial asset that generates consistent returns. And this asset-light mindset isn't stopping at batteries. In Europe, NIO isn't burning billions building warehouses like traditional automakers. Instead, they've partnered with DHL Supply Chain, utilizing the Holtum hub in the Netherlands as their central logistics node. They're preparing for their Firefly rollout without the infrastructure spending that usually destroys operating margins. It's expansion without the traditional expansion costs. Now, you might be wondering, how do you sell 3 different brands without cannibalizing your own sales? NIO has mastered what I call the 3 brands, 1 lease strategy. You've got NIO for premium flagship buyers, Envo for family volume, and Firefly for the urban mass market. By consolidating these into multi-brand stores, they've optimized their operating expenses and captured the entire market spectrum under one roof. It's automotive retail reimagined. And the numbers prove this strategy is working. Fourth quarter 2025 saw a 71% year-over-year increase in deliveries. But here's the kicker. January 2026 saw nearly 100% growth compared to the previous year. They're targeting close to 500,000 deliveries for 2026. This isn't incremental growth. This is aggressive scaling with a demand floor we've never seen before from NIO. But there's one data point that has some investors nervous. Wait times for the ES8 have plummeted from 26 weeks down to just 9 weeks. Now, is this because their factory efficiency is off the charts? Or are buyers freezing their orders in anticipation of something new? A rapid drop like this could signal softening demand, or it could signal something else entirely. There's a reason for this pause, and it's arriving on April 10th. This is the date that could change everything. Meet the ES9, the weapon designed to kill off any Death Valley concerns once and for all. With a 102 kilowatt-hour battery and a massive 385-mile range, this premium SUV is positioned for complete segment dominance. But it's not just about specs, it's about timing, positioning, and market psychology. This isn't just another vehicle launch that gets forgotten in a week. This is the catalyst that bridges the valuation gap between where NIO trades today and where it should trade based on fundamentals. This is why those ES8 wait times might actually be dropping. Buyers aren't losing interest in NIO, they're strategically waiting for the upgrade. They're postponing their ES8 orders because they know something better is just weeks away. And when the ES9 hits the market with its premium positioning and competitive pricing, it's going to reset the entire conversation around NIO's ability to compete in the high-margin luxury segment. April 10th isn't just a launch date. It's the inflection point that separates the believers from the skeptics. And if you think this is just retail speculation or wishful thinking, look at where the smart money is actually moving. Institutional conviction is exploding, and these aren't small bets. Goldman Sachs, one of the most sophisticated investment banks on the planet, increased their position by 57% last quarter. They're now holding a stake worth $71 million. That's not a speculative flutter, that's conviction. We're also seeing new entries from sophisticated quantitative funds like ABC Arbitrage, firms that run complex algorithms and only deploy capital when the math makes sense. These are the players who have access to better data, better models, and better insights than 99% of retail investors, and they're buying. The professionals are accumulating the structural pivot while the retail market is still stuck debating the old cash burn narrative from 2 years ago. When Goldman Sachs goes in this big, when quantitative hedge funds start taking positions, you have to ask yourself a serious question. What do they see that the market doesn't? What's in their models that hasn't hit the mainstream narrative yet? So what is all this actually worth? If you add up the asset-light evolution, the non-automotive profit engine, and the ES9 catalyst, you get a clear path from the current $498 price to that $8 bull case target. The market is fundamentally underpricing what NIO has become. This isn't a car company anymore. It's a technology and energy network with vehicles as one of multiple revenue streams. Before I give you my final verdict, I have to remind you, like always, this analysis is for informational and educational purposes only and should not be considered personalized financial advice. Always conduct your own due diligence. Consider your risk tolerance and consult with a qualified financial advisor before making any investment decisions. All right, here's my final verdict. This is a strong buy. NIO has pivoted to profitability, hedged its risks through REITs and partnerships, controlled its costs through smart logistics, and has a massive catalyst incoming on April 10th. The recommendation? Capitalize on this gap before the market re-rates this stock. But before you make your move, keep these critical points in mind. The data is clear, the institutions are moving, and the catalyst is coming. The question is, will you be positioned before the market wakes up? Thanks for watching Smart Stock Sam. If this analysis added value, smash that like button and subscribe for more data-driven stock breakdowns. I'll see you in the next one.